It's not about ignoring reality. It's about calmly separating fact from noise. If a great company's shares sink due to knee-jerk reactions or short-lived events, a contrarian might see a genuine chance to buy low. Most people who invest in the stock market want to beat the S&P 500 but end up failing behind. Imagine you're at a small town fair. One lemonade stand has a huge line because it's famous and flashy. Right next to it is a quiet stand no one seems to notice. Yet it actually offers bigger cups and top quality ingredients at a lower price. Most people ignore it simply because it lacks hype. In the stock market, many rush to buy shares of well known companies that everyone's talking about. Meanwhile, a lesser known business could be quietly performing well, boasting strong financials despite a slump in public opinion. Maybe they had a single bad quarter, or a rumor went around, pushing the share price down. If you dig deeper, like tasting that overlooked lemonade, you might find the product or the company is actually far better than people realize. Nobody wants to miss a rocket ride to quick profits, but hype often inflates prices beyond real value, setting up a nasty fall for latecomers. Picture your grocery shopping. Suddenly, apples become the biggest craze, and their price triples. Do you blindly pay more just because everyone else is? Or do you look for equally tasty but cheaper fruit that might give better value? Contrarian investors do the second. They question the actual worth of a stock before joining the stampede. In the long run, hype-driven spikes can crash hard. By staying disciplined and focusing on the stock's fundamentals, you can skip the buy high sell low trap. True, you might miss some short-lived rocket, but you also dodge the heartbreak when they come back to earth. Meanwhile, you're discovering stocks with more stable growth potential. And many assume that if a stock is unpopular, it must be a contrarian goldmine. They buy simply because everyone else is selling. This approach confuses unpopular with undervalued. An unpopular stock might be disliked for a very good reason, like flawed products, poor management, or unsustainable debt. If you jump in just to be different, you could be stepping into a money pit. When you buy a stock only because the crowd hates it without investigating its fundamentals, you risk major losses. The company's issues might be far worse than you realize. You might hold on to false optimism, telling yourself the market is wrong, when in reality, the market is fairly priced in a dime business. This mistake can crush your portfolio and your confidence.